Imagine you just came into a life-changing amount of money. Maybe it's a work bonus, an inheritance, a tax refund, or you finally sold that old car. You have $50,000 sitting in your bank account, and you know you want to put it into a broad market ETF like the S&P 500 or an all-world index fund. But then, the anxiety hits. Do you take that entire pile of cash and dump it into the market all at once today? Or do you drip feed it, say, $4,000 a month for the next year to play it safe? If you put it all in today, what if the market crashes tomorrow? But if you slow play it, what if the market rockets to all-time highs and you leave thousands of dollars on the table? This is the ultimate showdown: lump sum investing versus dollar cost averaging. Today, we aren't relying on gut feelings or internet advice. We are looking at the hard math, major institutional studies from Vanguard and Northwestern Mutual, and the psychology behind both to figure out exactly how you should invest your hard-earned money. Before we look at the numbers, we have to clarify what we actually mean by these terms, because the internet loves to confuse them. First, there's lump sum investing. This is straightforward. You have a set amount of capital available right now, and you deploy 100% of it into the market immediately in a single transaction. Then, there's dollar cost averaging, or DCA. This is where you have a lump sum available today, but you deliberately choose to divide it into equal portions and invest it at regular intervals over a fixed period, like 12 months. Now, an important note here. If you are investing $500 every single month out of your regular monthly paycheck, that is not technically the tactical DCA strategy we are debating today. That's just called investing as you get paid. Today's debate specifically applies when you already have a large chunk of cash sitting on the sidelines and you're deciding how to move it into the market. The core argument for DCA is that it smooths out market volatility. If the market goes down, your fixed monthly amount buys more shares at a discount. If the market goes up, it buys fewer shares. It feels safe. It feels logical. But as we are about to see, intuition and investment mathematics rarely agree. Let's look at the numbers. If your goal is purely to end up with the most amount of money at the end of your investing horizon, the debate isn't even close. Lump sum investing wins by a landslide. Look at the evidence. Vanguard conducted a massive, definitive historical study analyzing market data across the US, UK, and Australia over rolling 10-year periods. They found that lump sum investing outperformed dollar cost, averaging roughly 68% of the time. That's a nearly 2-to-1 win rate for throwing all your money in on day one. For an all-equity portfolio, choosing to lump sum invest generated historical returns that averaged 2.4% higher than a 12-month DCA strategy. A separate study by Northwestern Mutual looked at a $1 million windfall invested in U.S. markets over rolling 10-year periods. They compared immediate lump sum investing against a 12-month DCA schedule. The results were remarkably similar. In a 100% stock portfolio, the lump sum approach generated better cumulative total returns 75% of the time. In a balanced 60-40 stock and bond portfolio, the lump sum won 80% of the time. Why does lump sum dominate? It boils down to a fundamental truth of the stock market. Historically, the market goes up more than it goes down. Markets spend roughly 70% to 74% of the time trending upward. When you choose to dollar cost average a lump sum over 12 months, half of your money is sitting in a cash account for the better part of a year earning next to nothing. This creates a massive problem called cash drag. A study by PWL Capital showed that by holding cash on the sidelines during a 12-month DCA period, you leave an average of 0.38% annualized return on the table over a 10-year period. Over decades, that cash drag compounds into thousands of dollars of lost wealth. To make this crystal clear, let's look at the direct trade-offs of both strategies so you can see where they actually shine. With lump sum investing, Your biggest advantage is historically higher returns and maximum time in the market. It's incredibly simple, one transaction and you're done. The disadvantage: high psychological risk. If the market drops tomorrow, you feel immediate regret, and you are highly vulnerable to short-term volatility peaks. On the flip side, dollar-cost averaging gives you massive regret minimization. It outperforms beautifully during a sustained bear market, and it eases nervous investors into the game. But the downside is suboptimal math, cash drag, and the fact that you suffer heavily during a bull market because you keep buying at higher and higher prices. So, if the math screams lump sum, why do so many financial advisors and content creators still tell you to dollar-cost average? Because of human psychology. Behavioral finance studies show that humans experience the pain of a financial loss twice as intensely as the pleasure of an equivalent gain. This is called loss aversion. Imagine you lump sum $100,000 into an ETF today, and next week, a geopolitical crisis causes the market to drop 10%. You just lost $10,000 on paper. Logically, if you are holding for 20 years, this drop is just noise. But emotionally, you feel physically sick. You might panic, pull your money out at the absolute bottom, and ruin your financial future. If you had used a 12-month DCA strategy instead, and the market dropped 10% next week, you'd actually feel excited. You'd think, awesome, my next $8,000 installment is going to buy the ETF at a 10% discount. DCA acts as an insurance policy against your own emotions. You are intentionally giving up a portion of your expected historical returns in exchange for peace of mind. If a strategy helps you sleep at night and prevents you from panic selling, then it is a good strategy, even if a spreadsheet says it's mathematically suboptimal. So, what is the final verdict? How should you actually deploy your next windfall? Here is your playbook based on the research. Use lump sum investing if you have a long time horizon of 10 or more years, a high risk tolerance, and the psychological discipline to watch your portfolio drop right after investing without panic selling. The data proves this will give you the highest probability of max wealth. Use dollar-cost averaging if the cash represents a massive percentage of your net worth. You are highly anxious about market levels, or a sudden drop would cause you to sell everything. Now, if you're torn right down the middle, you can use what I call the institutional hybrid approach. Instead of stretching your DCA out over 12 agonizing months, compress the time frame. Put 50% of your lump sum into your chosen ETF today. Then, break the remaining 50% into 2 blocks and invest them over the next 30 and 60 days. This gets your money exposed to the compounding power of the market quickly, but gives you a 60-day buffer to protect your psychology against an immediate market shock. At the end of the day, the best strategy is the one that keeps you invested. Time in the market will always beat timing the market. If this deep dive helped clear up the confusion, hit that like button, subscribe for more data-backed investing guides, and let me know in the comments. Are you a lump sum risk taker or a DC